we've been talking about the Federal Reserve kicking off its two-day policy meeting today. Officials widely expected to raise rates by another 75 basis points, announced tomorrow. This would be the fourth consecutive 75 basis point hike. Joining me right now is former Kansas City Federal Reserve President and CEO. He is the former FDIC Vice Chairman and a distinguished senior fellow at the Mercatus Center. Thomas Hoenig is here. Thomas, it's great to see you this morning. Thank you so much for being here. A lot to get to with you. We've had this rally underway in stocks because investors are somehow surmising that maybe after the 75 basis point hike tomorrow, maybe the Fed starts inching back, maybe starts doing 50 basis point, 25. What are you expecting to hear from the Fed? And are you expecting a 75 basis point hike?
Well, first of all, I am expecting a 75 basis point hike. I think the signaling on that's been pretty loud as far as the Federal Reserve is concerned at this point. So I think that's kind of baked in the cake. But I think the issues then will become what next, as others have said. Will it be 50, 25? And the answer to that is I don't think anyone knows. I don't think the Fed has an end point in mind because they don't know where inflation is going from here. They're hoping that it'll moderate, but they don't know that. So they'll be, I hope, very careful in what they say at tomorrow's press conference and not signal any kind of future move. Now, that means there'll be more volatility because it will create uncertainty, but there's still a lot of liquidity in the market. You can see that with the merger announcements. You can see it in terms of the market's expectations, ability to move the market up. So there's a lot yet to be done, I suspect, in terms of addressing inflation and interest rates.
Yeah, and by the way, a pivot is not just a change in the size of a hike in interest rates, right? It could be about the balance sheet. Let's talk about this because you and I have talked about this a bit before. The balance sheet is a big deal because if they stick to the plan, liquidity could become a challenge for the economy. Let's talk about that. Were you going to say something before I pivoted to the balance sheet?
No, I was just going to say that the other issue is the balance sheet is right there. It's extremely large, almost $9 trillion still. They're planning to reduce it $195 billion a month. That takes liquidity out of the market. You hear people talking about liquidity in the Treasury market right now, but there's still a lot of liquidity in that market. And pulling that out means you begin to constrain the economy and I think create uncertainty around the financial sector. So that will be an add-on to the inflation uncertainty as we move forward from here. So while people are apparently very optimistic in the market, there's still a lot of reasons to be cautious as they go forward from here. And a lot of reasons for the Fed to be cautious in what they say going forward from here, because I don't think they know their end point yet.
Well, I want to talk more about this liquidity issue, Thomas, because people don't really think about this too often when you're talking about what the Fed is going to do. The headline is always the rate hikes and what the impact on the economy is. But walk us through why liquidity could be a challenge for the economy, how that plays out in a practical way.
Well, think about it. One of the things you did when you did quantitative easing is you pumped a lot of reserves into the banking system in the expectation that that would be loaned or used in some fashion to stimulate the economy. So reverse that and think about when you're pulling money out of the economy, reserves out of the system, that is the banks, the largest banks and banks accounts with the Fed are being shrunk, being reduced to some extent every month. You're taking liquidity out. So you have less available for lending, for putting it into the market. And so that tightens the economy in addition to the interest rate. And therefore, you really are squeezing down the economy as you hope to get inflation down. But that takes time. And I suspect a fair amount of volatility going forward from here because inflation is still way too high for the Fed to really moderate their policy too much at this point, including moderating their reduction of the balance sheet, which is far too large. It's $9 trillion. It needs to be much smaller than that. But if you do it quickly, you will then, I think, shock the economy and shock the financial system, and they know that. So it's, central banking is not a science. It's more of an art. And they are, I think, trying to navigate very, very carefully in this environment. And their challenge is huge, both in the liquidity side. How do you keep that balance, and on the interest rate side, not to choke off the economy and bring it into a major recession. I think a recession's pretty much going to occur as they continue to tighten and shrink their balance sheet. It's the degree that I think is really in discussion right now.
Yeah, and I want to ask you about the degree, because let me just reiterate that you saw all of this coming. You were the one dissenter back in 2010 when the Fed was considering all of this stimulus thrown at the economy. You said, no, this will lead to inflation. That is exactly how this played out. But in 2023, we're talking about some serious scenarios here. We just spoke with the head of the union, one of the unions that rejected a tentative deal by Joe Biden for the rail companies. If we have a rail strike, layer that on to the worries about the economy. Layer on top of that this 40-year high inflation and the impact of 4 75 basis point hikes, making borrowing so much more expensive. We see how it played out in the housing market with 7% mortgage rates. How would you assess your expectations for 2023 in terms of the macro story right now?
I think it's going to be a very difficult year. And the way I tell this is, think about it. You've put a major economic system called the United States economy, and you've created an equilibrium over the decade of close to zero interest rates. So you have the entire economy adjusting itself around that zero. And now you're going to move that by increasing it by a factor of 15 if they go to 375, and you're taking liquidity out of the economy. You are really going to be shocking the economy almost with that kind of an increase. And think about it. If you imagine any kind of good that would trade for very long at a zero price, and suddenly you're going to increase that price dramatically. You're going to have a very unstable market. And that's what we've done with interest rates. We've kept them very low over the decade. Now we want to move them up. I think we are going to have a pretty tough time doing it. And 2023 we're going to see a recession, and I think it'll be a fairly difficult one. Now, the advantages going in right now, I recognize them, is unemployment remains relatively low. That's true. There is still a lot of momentum in the economy. That's true, but there's also a lot of other issues. So we have a tough year ahead.
Thomas, great analysis as always. We so appreciate your time. Thank you, sir. Thomas Hoenig joining us this morning.